How do you know if a market is about to switch from a consolidation to a full trend? This may be obvious in hindsight when you look at the previous charts, but in real time, this is a major challenge for all traders. You know the situation. You've got a setup that you like on a market that you follow, but the market looks like it's in a range. What do? You take the signal or wait. Luckily for us, there's an interesting tool that can help to detect when such a switch from consolidation to trend might be near. In today's video, we'll discuss about the TTM squeeze indicator, and I will share how to use it and how to trade with it to find the best setups. TTM squeeze is a volatility and momentum indicator, which is based on the tendency for price to break out strongly after consolidating in a small price action range. Trading price action is a pretty straightforward idea of understanding support and resistance levels. However, understanding momentum and the direction of price at these levels is probably one of the most difficult concepts for many traders. Being able to spot momentum increasing or decreasing at these levels makes the difference between success and failure when entering trades. That's why TTM squeeze makes spotting momentum changes and incoming volatility much easier. The TTM squeeze indicator visualizes the relationship between the Bollinger Bands and the Keltner channels, which helps to identify when an asset is consolidating, meaning squeezing, and signals when prices are poised to break out. If the Bollinger Bands are completely enclosed within the Keltner channel, that indicates a period of very low volatility. This state is known as the squeeze. When the Bollinger Bands expand and move back outside of the Keltner channel, volatility increases, and prices are likely to break out of that trading range in one direction or the other. The TTM squeeze is comprised of two main components. First is the momentum oscillator. This is the vertical histogram, which indicates the direction of momentum. The green vertical lines is positive momentum, and the red vertical lines is negative momentum in relationship to their positions above or below the horizontal zero line. The zero line is the second component. This horizontal line is where the squeeze is visualized by a series of green and red dots. Green dots are a condition of no squeeze, and the red dots are when the price is squeezing. The squeeze signal, meaning the red dots, appears when the Bollinger Bands are squeezed into the Keltner channel. Now let's actually add the Bollinger Bands and the Keltner channel to the charts. As seen, these squeeze conditions represent the consolidation of price, with Bollinger Bands within the Keltner channel, which corresponds to a series of red dots appearing along with the zero line on the TTM. Increase in momentum is represented by higher bars on the momentum histogram on the TTM and the expanding of the Bollinger Bands, with the release of the squeeze seeing the red dots turning green. The TTM squeeze indicator helps to take a lot of the guesswork out of the momentum equation, with a simplified representation of what's happening when the Bollinger Bands and the Keltner channel enter a consolidation phase. And you have a much simpler and cleaner chart. So how to read and how to trade with the TTM squeeze? As said before, the TTM squeeze has both volatility and momentum components. The squeeze dots signal volatility conditions, while the momentum histogram indicates the direction, long or short, in which to trade. In the TTM squeeze, we have an horizontal line that changes color between green and red. This represents the situation of the market in the current moment. If we happen to find that the TTM squeeze horizontal line is red, it means that the market is in a consolidation period and is not ready to move just yet. However, if we finally spot a green dot after a series of red dots in the middle line, this means that the market is finally ready to move, and it will most likely do it in a somewhat aggressive way because volatility increases and the Bollinger Bands expand until they are outside of the Keltner channel. The author of the indicator recommends taking a trade on the first green dot after one or more red dots. But the question that remains is, in which direction will the market move? Now, the momentum histogram helps to determine the direction in which to trade. If the momentum is above the zero line and rising, long trades are recommended. If the histogram is below the zero line and falling lower, short trades are recommended. The histogram bars are color-coded. Bars above the zero line are green, and below the zero line are red. In addition, a bar that is lower than the previous bar will be a darker color, and a bar that is higher than the previous bar will be a lighter color. When the histogram changes direction and starts moving back towards the zero line, that's a signal to sell. The momentum histogram can also be used to determine specific exit points, like selling when you had 2 bars in the new color. For example, if the squeeze fires and the bars are above the zero line and increasing, you could sell when you see 2 bars in a row above the zero line and decreasing. Just to be clear, when you analyze a market, your focus should be on the zero line. The red dots by themselves are not a signal for entering a trade, but should be used in combination with the vertical momentum bars. As the momentum bars near the zero line, this is the signal or condition that we should be looking for, which indicates that momentum is shifting into positive or negative territory. Once these conditions are met, an entry can be considered. There are many options about when to enter the trade at this point, once a momentum shift has been confirmed. Some traders do so on the first bar, others after 1 or 2 bars have been confirmed. This is something that you will have to determine on your own. In this 15-minute chart, we have marked several squeeze signals. The first squeeze is quite clear. It is marked on the left side of the chart. As you can see, the TTM squeeze indicator is telling us that there is a movement ready to go in price, and it will most likely be bearish, as the red bars appeared exactly with the squeeze. However, the second squeeze direction is not so clear. The TTM squeeze histogram tells us that it will most likely be a bearish one, but the truth is that it ended being a bullish squeeze. In any case, this is a perfect example of why we should be using stop-loss orders to avoid extreme losses. The third squeeze, even when it takes some time to finally move, does it to the upside. Here's another example on the 1-hour time frame. The TTM squeeze gives a perfect long entry. Several red dots appeared, indicating the market has built enough consolidation energy and is ready for a squeeze. The red dots have a green histogram rising upwards, indicating that there is bullish momentum lurking beneath this energy. The previous trend was also bullish, an important aspect to consider when analyzing a setup. My preference is to look for squeeze trades in the direction of the main trend. In this case, as expected, the market responds with an aggressive spike upwards. Don't expect the market to move immediately after that color change. In some cases, the market will take some time to start a new move up or down. Here's an example to illustrate this on the 1-hour time frame. We can observe the red dots shift to green dots, and we know there is bearish momentum behind the potential squeeze, an ideal entry for a short trade. The setup was obvious for a short trade, but the price didn't move right away in the expected direction. We had to wait a bit longer before the move came. And of course, in some cases it will move in the opposite direction, so make sure your risk and money management is on point. Here are other examples of valid trades. Another way TTM squeeze indicator can be traded is by using divergence. Divergence is when histogram momentum bars begin to slope toward or away from the zero line, and the price moves in the opposite direction on the upper part of the chart. Bearish divergence is when price is making higher highs, but the slopes of the histogram on the TTM are making lower highs on the positive side of the zero line. Bullish divergence is when the price is making lower lows, but the histogram is sloping toward the zero line from the negative side of the line. Like any other technical indicator, the TTM is no magic bullet, and it would be best used with other indicators as a confirmation of price direction. You could add a moving average, or the Ichimoku cloud for example, or even switch to a Heikin-Ashi chart to visualize the main trend better. Also, the TTM squeeze can be used in many timeframes. My preference is to look at the same market in multiple timeframes for confirmation. For example, if a squeeze is firing on both a daily and an hourly chart at the same time, that's a stronger signal than a squeeze that is only firing in one timeframe. Lower timeframes are typically used as entry and exits to support the higher timeframe when day trading or swing trading. Just remember these steps. Find areas of consolidation with the red dots. Look for momentum to break out in the direction of the main trend and confirm the movement with a higher timeframe. If you learned something new and found value, leave us a like to show support, and don't forget to subscribe and hit the bell icon to get notified when we release new videos. Until next time.